I'm Charlotte McLeod with the Investing News Network, and here today with me is Rick Rule of Sprott. Thanks so much for being here.
Pleasure, thank you.
Yes, so I'm going to jump right into it. Let's start with gold. It's been an interesting last week or so. What's your explanation for the recent price volatility we've been seeing?
In my experience in the very near term, in liquidity crises like the one we experienced last week, all assets get sold. The sale doesn't necessarily take place because the investor wants to sell it. The sale is generated by the margin clerk. People who owned gold on margin experienced a margin call. My other experience, however, is that if the policy reaction to a liquidity squeeze is to inject more liquidity, that's generally very good for gold. If you look back to 2008, the initial response was a sell-off. The ultimate response, as a consequence of the official sector cure, was very good for gold. And my own suspicion is that that's likely to occur here as well.
Right, so we have seen some people be a little bit confused that gold and the markets are both going down at once, and you would explain it by saying it's these people who are having their margin calls and things like that.
Absolutely.
Yeah.
And, people react to things in an immediate sense, but markets take time. And people have a time preference, and that time preference, the fact that people want the action that they expect to take place immediately, do themselves harm. They do themselves harm. Yes, we have time preferences, and no, our preferences don't matter.
So I was going to ask you, you mentioned kind of looking at the past. I was going to ask if we have seen something like this before. Are there times we could look back on when this happened and we can make a prediction about what's going to come next?
I don't know if we can make a prediction, but certainly we've seen circumstances where we had violent market disruptions that were liquidity and trust driven. One would have been 2008. Another would have been the tech wreck of 2000. Before that, probably 1990 and 1987. In each circumstance, every asset class fell as a consequence of liquidity. What are called tertiary assets, that is the most speculative assets, junior mining stocks, classically among them, emerging market, frontier market stocks also, really get clobbered in circumstances like that. There's a flight to quality, and assets that aren't perceived as high quality assets, speculative assets, get clobbered.
Okay, so it sounds like you're saying there might be an opportunity in there for people who are willing to jump into those stocks at this moment.
Certainly to the extent that you want to increase your exposure to tertiary assets, they're coming into a season where they're going to be on sale. In my life, buying financial assets the way that you buy physical assets, that is to say when they're on sale, has suited me well. It's hard on the nerves, but it's good for the pocketbook.
Okay, so you mentioned, we were looking back at the past, this is similar to 2008, other big market crash. I think a lot of people are wondering, are we really heading towards something big like that? Is there a recession coming in the US, globally? What's your take on that?
I'm not an economist, I'm a credit analyst. I believe that we're probably overdue for an economic slowdown. The way most people measure this recovery, it's been in place since 2009, 2010. That means it's 10 years old. Historically, that's fairly long of tooth. I would argue also that a lot of this recovery has been driven by artificially low interest rates. It's been credit driven rather than fundamentally driven. So I wouldn't be surprised to see this as the beginning of something deeper, some form of recession. But I'd like to caution your viewers, in fairness, I'm a credit analyst, I'm not an economist. This isn't what I do, these are my suspicions.
And you mentioned rates have been low, and we have been hearing central banks are perhaps considering cutting further to do this. Do you see that happening?
The policy response that's been exhibited by central banks for a very long time has been to deal with every crisis by adding liquidity. In my opinion, probably postponing the inevitable.
Right.
Certainly to the extent that lower interest rates are accompanied by accommodative fiscal policy, that is quantitative easing or modern monetary theory. Understand that those are political buzzwords for counterfeiting. It's just who does the counterfeiting. If that circumstance occurs, it may or may not save equity markets in the near term, but it should be very good for precious metals markets.
So would you expect, and I know we're predicting again, but would you expect gold to, what level could we see gold go to? Because we were very high, we've kind of been, now it's low.
I understand your reason for asking the question, and I'm not ducking it deliberately. The question that you ask is more the impact of the narrative on a market, and that goes more to your skills as a journalist and mine as a credit analyst, frankly. People say, could we have $2,000 gold? Yeah, absolutely. Will we? I don't know. I mean, I really, truly don't. One of the things that you need to ask yourself is, how do you measure it? You measure it in US dollars, which itself is an ephemeral value. My suspicion is that if you measured the gold price relative to the number of hours per year that an average worker would have to work to buy an ounce of gold, that the price of gold relative to labor will go up, and go up substantially. And I think that's probably the fairest way to measure it.
Okay. So I guess what many people have said is driving gold this past week, this past month, is all this coronavirus activity. Would you say that is what is the driver? I guess is my first question, and then I have another question.
I think it's the trigger.
Mm-hmm.
I think it's an excuse. I think that there were underlying concerns in the market. My own concern with gold equities prices, as an example, is that many of them are up 50 or 60%. In other words, they cease to be cheap. And usually asset classes require a rest. And my suspicion is that there were pressures building in both debt and equity markets for a reset. And we certainly got a good excuse. Marginal growth worldwide, 30% of marginal growth worldwide is China. And the fact that China has slowed up substantially means, pro forma, that world economic growth has slowed up substantially, both in terms of demand for stuff, but also in terms of China's place on the supply chain. So it makes absolute sense that this is a real rather than just a psychological trigger.
Right, okay, so this does tie into my next question. At VRC in January, we spoke with a lot of people. One of my main takeaways was that gold's most important drivers are the underlying factors like interest rates, debt, not those kind of more short-lived factors. So I was going to ask, where does the coronavirus fit in that picture? And you've kind of explained it, but maybe you can talk a little bit more. Is it shifting from being one of those short-term things, or does it become a long-term thing because it's triggering all these?
You may remember our interview in January where I said gold's position in my portfolio is as an insurance asset. I own a lot, and I actually hope it doesn't go up in price because you don't want to get paid. I mean, you don't want a bad thing to happen, which is what triggers an insurance payment. My belief is that the most likely outcome in the intermediate term will be accommodative fiscal policy as a consequence of perceived economic weakness. And that's generally very, very good for gold. Negative interest rates are good for gold. The US 10-year Treasury is at an all-time low, a negative real interest rate, which both weakens the dollar and also weakens 10-year Treasuries as an alternative for gold. So my particular bias is that gold almost can't help but do well.
Okay, and so for investors, we're here at PDAC, there's going to be lots of investors wondering that what they should be doing during this time. What would your best advice be for them?
Well, for investors who don't know what to do, build liquidity. I'm in a very different circumstance. There are 80 or 90 companies that are on our watch list, and they're getting cheaper by the minute. We will certainly use the next 3 months as opportunities to build large positions in speculative companies that we want to own. We believe that we won't have very much company doing that, which is okay with us. We're investing for the 2 or 3 year time frame. We're investing, as we've talked about before, in terms of answering unanswered questions. And the fact is that the cover charge to get an answer to the question got 20 or 30% cheaper, which from our point of view is a very good thing.
Right, and I guess that for investors, you're looking for the best time to kind of check things off your shopping list. What's your signal that, okay, now is the time, now is the lowest that it will get at this point?
I can't do that, in fairness. So, famous speculator a century ago, Bernard Baruch, said the only person who ever bought at the bottom and sold at the top didn't exist. He was a liar. And I don't believe that I have the ability to bottom tick the market or top tick the market. What I do believe is that if I think that a fair price for something based on the liquidation value of their assets is $1, and I can buy that for 50 cents, that's better than buying it for $1.50. And
Sure.
that circumstance is certainly in front of me. For people who don't have the ability to, in their own mind, frame a valuation, they should not be in this market.
Okay, and last question. We've been talking about what should investors do right now, what are you doing right now? What would you want to see companies doing right now? Junior miners, is there anything they should be doing differently?
Amalgamate, first of all.
Okay,
The thing that the sector needs most is lower general and administrative expense relative to assets under management and relative to total expenditures. There are probably 2,000 listed juniors worldwide. There are probably 200 that are viable. We need to take a zero off that total. We won't be able to do it, but what juniors should really be doing is amalgamating.
do you think they're going to?
No, I don't.
Okay.
Somebody loses his or her job in amalgamation. And the truth is that to the management teams, their salaries are much more important than shareholder valuations. So what should happen is what won't happen. But you asked me the question.
That's
and
true.
so
That's
I
true. So
answered it.
realistically, what might happen in terms of mergers and acquisitions in the space this year?
I think what you'll see is that reasonable people will do it. It's just
Okay.
that the population of reasonable people relative to total people is fairly small.
Okay, let's leave it there. That was great. Thank you
Thank
so
you.
much. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Rick Rule of Sprott.